corporate earnings in the economy is strong enough to mitigate any negative impact of higher rates on consumers or valuations?
Again, if interest rates are rising alongside stronger growth, I think we're fine. However, one thing that I've been writing about and watching for the last 6-9 months is the corporate debt situation. Outside of financials, we're back to levels of leverage in the U.S. corporate sector that we haven't seen since 2007, 2008. So understandably, companies took advantage of quantitative easing and low interest rates to borrow. But now we're at a point in time where 10% of U.S. companies cannot even meet interest coverage with current revenues. 10% already, and that's before the Fed hikes further. So if the Fed were to get aggressive and hike quickly and we didn't have strong growth with that, I think the corporate sector would be very vulnerable, particularly in certain parts of the economy like retail and some energy companies.
So you're watching default rates too?
Well, default rates tend to be very backward-looking. When we hit the crisis, default rates won't tell us it's coming. They'll tell us it came. So I think for me, it's really understanding, is Jerome Powell and team going to try to get ahead of the inflation curve, or are they going to let the economy run hot? My base case would be they let it run hot, only because central bank chiefs in every country in the world, if they have to make a mistake, create a bubble or create a recession, I think they take the bubble. If you have a recession and that's your legacy, it doesn't sit well with you. So if we raise rates gradually, maybe we have a bit more inflation. As long as growth is there, I think stocks do fine and the credit markets can be okay. If Jerome Powell decides he needs to get hawkish, inflation is getting away from him, I think our first sign of trouble that leads us to the end of this bull cycle, we'll probably see that first in the credit market.
Well said, Rebecca Patterson.